Welcome to another edition of Inside the Economy. I'm Larry Howes. This time I want to talk what the CPI did, the Consumer Price Index, real house prices, profits in the stock market, and a little bit of China and Japan on some questions. Quick look at the numbers. What we have here is some anticipation that we were going to really have CPI numbers come out and scare everybody. Well, they came out and they didn't scare anybody. They were kind of unexciting, which is good, considering all the fear about tariffs, which we'll get to here in a minute. We had a slight increase in initial jobless claims, and that was corrected. It was a number problem. And the interest rates have adjusted. They have adjusted up. If you look at what they were a year ago, they've almost flipped again, which means the yield curve, those of you that care about the yield curve, is getting better. Mortgage rates, yeah, we'll get to that in a minute too. Here's CPI. Things like core shelter, they're creeping down. They're not plummeting, they're just creeping down, which we anticipated they were going to do anyway. There isn't any drama here, and there isn't any impetus to lower rates, and we've talked about that before, and we will again here in just a minute. But as long as we have inflation up here, remember the Fed's target is 2. As long as we're in the upper twos, you don't want to lower rates because you'll stimulate and you'll push those numbers back up again, which is sort of a conundrum. We'll talk about it a little bit. Retail sales, you think the consumer's slowing down? No, they're not. The retail consumer side of the entire S&P 500, which is the yellow there, is not slowing down. It's doing very well. Retail earnings are doing very well. It's not an economy that's slowing. In fact, it's picking up. Well, some people that do sound bites in Wall Street says the U.S. economy is getting its swagger back. Don't quote me on that. The housing market is a great indicator, always is. There's not a slowdown. This is single families up there in blue and multifamilies, permits, starting permits. They're not slowing. They're seasonally adjusting. Single family units are moving right along. And the big problem with, multifamilies are going to have trouble financing because interest rates are high. No, they're moving along just fine. In fact, there's about 9 new big projects just in Denver alone. Prices are not accommodating, not correcting, not saying, the price has got to come down because the cost of money is up. We'll get to the cost of money here and interest rates in a second, but no, these prices are actually stabilizing. It's great history in here, the time frame for price corrections, but there's nothing suggesting we have a price correction in the near future. Even if rates come down, let's say rates do come down and mortgages come down, prices don't go down, prices go up in a situation like that. And the current environment, we're late 6s and the interest rates for mortgages, that's kind of what it is. That's where interest rates were back in 16, 17, 18, relatively free. That's what everybody got used to, mortgages in the 3s. Then it dropped basically to free. Now it's been up in the 6s for a while, and nothing suggests that's going to change. So if you're really betting the farm on doing a refinance, don't count on that. The S&P 500, this has been a great chart the last 3 months. Everything has been great after the correction. What we are now is a little overpriced. Even though earnings have been coming out, and most of the earnings look good, they really do, we are a little bit overpriced. This is what's known as price to perfection, meaning every possible penny in earnings is really generously in the market. We're at 22 times forward earnings, so it's a little bit steep. It should correct a little bit in August. It'll be a great time to buy on the dip, as they say. The economy is moving in such a way when the first quarter estimates for the first quarter of GDP came out, remember there was a negative half a point, negative 0.5. Well, the second estimate's going to be in the positive twos, low twos. It's not slowing down, it's picking up. There were great expectations that earnings were going to drop off a little bit and correct this market. This was anticipation. The earnings are better than they thought. Volatility has dropped. We've gone like 11 weeks, 12 weeks without a change up or down more than 1%. That's very low volatility. That's fat, dumb, and happy in the market. And the earnings have supported that. We just don't have any reason to think that there's any drama coming either way, certainly not up or down. If there is a little down, it won't last long. So on the tariff side of thing, what they pull in, $26 billion in tariffs. Okay, great for the government. It's a drop in the bucket for what the government needs, but it's a step in the right direction. Some of that and most of that has already fit into the inflation numbers. This isn't over, but what we're going to have, this is the end, basically the end of July, close to the end of July. These tariff deals are going to be done by the end of summer. I originally predicted the end of June. There's been a little extra chit-chat. It'll be the end of summer. The tariff deals will come around, and the pressure out of that will ease, bring the CPI down, which will put more activity in the business, so on and so forth. The line item I talked about a couple of weeks ago, the cost of federal interest payments, basically the interest paid on money that's out in the system, the $37 trillion that's out in the system right now. Yes, that is an expensive line item. It's over $1 trillion a year. And again, that's the reason why the administration is encouraging the Federal Reserve to lower rates. You lower rates, you make this line item smaller. Yes, it's a big deal. $28 billion in tariff income is a drop in the bucket compared to this. Big, little. The Japanese had a political revelation this weekend. They got rid of the party that's basically been running the country since the 50s. They might be going down a populist route. They might be tired. They might be bored. I don't know what it is. But fundamentally, the Japanese as a group have not done well compared to everybody else. The gray line there in the middle is Germans, and of course the top line in the U.S. That's GDP per capita. They're going to have to change some things. They are losing population rapidly, faster than anybody, even faster than Russia. But I don't think they want to waste the next 80 years. So there's going to be some changes. I don't know if Japan is going to start trading more with other people or get in the defense business or whatever it is. They need to get active again because the passive, just get along with everybody version of Abenomics, which is why it's in here, is not working for them. And a couple of questions on the Chinese. Has their international trading, their exporting collapsed? No, it hasn't. It has slowed a lot with the U.S. It has picked up with other Asian nations, so the other Asian nations can trade with the U.S. China has to export. They don't have anything else. And they have to export because they got a lot of mouths to feed. We don't want them to collapse. That will just make the current problems, the floods and the disappearing dams, worse. It will help Vietnam and Indonesia and a bunch of other close, we'll call them competitors, but China's not going to collapse. They can't. They've got too much on the backside that is hurting them a lot. They've got 2 years now of deflation in their lowering prices in their system. And if you're a low-end manufacturing service like China is, you can't have this much lowering prices because your prices were already the lowest on earth and very thin margins to begin with. So this is bad news, and it really isn't had an impact yet. And finally, the most costly and damaging part is how the direct foreign investment and money from around the world is not going to China anymore. It's not a particularly attractive place to invest. I don't see it changing in the foreseeable future or ever. As always, if you have a question, send it along to info@shjwealthadvisors.com. I'll be happy to deal with it. And thanks for joining me.